Let's also bring on board Manpreet Gill, Head FICC Strategy at Standard Chartered. He joins in live from Singapore. Manpreet, hi, morning. Just going through your report, and you've talked about as to how global equities have been climbing the wall of worry for some time. Let's start off with US equities. What when tapering actually kicks in? Do you think the rally in the markets is going to last then as well, because all of it is almost priced in?
Well, we've always expected tapering as and when it comes to, potentially be a bit of a speed bump. But what we're really trying to do is separate out, short-term speed bumps from, an asset class that fundamentally looks attractive on a much longer time frame to us. We have had equity market setbacks in the past, but, if you look at the history of the S&P, for example, since 2009, these setbacks have ended up being excellent buying opportunities. And to us, as long as the liquidity picture still remains supportive, as long as the economy is actually recovering, and earnings sort of continue to grow alongside, that's positive for equities. Remember, if the Fed's tapering, they're most probably doing so because the economy is actually improving to a point where they can pull back on the liquidity, and that's ultimately positive for the equity market.
Manpreet, but there is a consensus view on, or there is a view on the street that Fed actually may not taper in 2014. They may talk about tapering, they may indicate the intention to taper, but eventually tapering may not start. What are your thoughts on that?
Well, that scenario is always possible, but to us, that's only possible under the scenario where the Fed does not see the improvement in the underlying data that they're looking for. Our view is that factors like the housing market and the labor market are still the two most important factors for the Fed, and on both those counts the economy is improving largely on expected lines. So if you take a look at the employment market, I mean, the US economy is adding a sizable number of jobs every month. If you look at the quarterly average, it's not actually too bad, and the most recent data points were really sort of affected by one-off factors around the US government shutdown. The other side is that there is a cost to maintaining quantitative easing for much longer. I mean, if you look at the impact on the fixed income market, for example, the Fed is cognizant that QE policy is not without its costs. And at the end of the day, if the labor market and housing market continue to recover at the pace they are, we believe it's much more likely that the Fed will, start pulling back on its purchases rather than, risk carrying those on for too long.
Manpreet, so what's the view on equities like India? I mean, we're sitting at almost all-time highs when it comes to our frontline indexes, but the large part of the market is still way underperforming.
Well, in India, there are a number of different risks. We hold a neutral view on Indian equities in a regional context, in Asia ex-Japan context. And the reason for that is that there are two clear risks for the Indian equities. I mean, on one hand, if we do see Fed tapering, one question mark is, will we see a repeat of what we saw, a couple of months back when, there were concerns that the Fed might taper and capital flowed back to the US. The second factor is that, from now until the general elections, there are a number of political risks in India, and it really depends how, elections both now and when the general elections happening in early 2014, it depends whether we get a clearer mandate or not. So there is a possibility that equity markets could do very well if political risks turn out to be much less than what a lot of us fear. But at the end of the day, there are a number of question marks. So to us, yes, we hold a neutral allocation. We believe, there's good reason to believe that absolute returns should still, just about be okay, but we just believe, there's much better returns to be had in the developed markets right now.
Manpreet, I have a very basic question for you. Equities as an asset class, they always do well when interest rates, they come down. Right now, interest rates not only for emerging markets but for all developed market economies are poised to go higher. They could go up in 2014, they could go up in 2015, that is debatable, but the trajectory is that interest rates will go higher. So if interest rates are poised to go higher, why should equities do well?
Well, equity markets don't always do badly when interest rates are rising. Ultimately, what matters is at what point in the interest rate cycle are we? If interest rates are rising to the point where financial conditions are becoming tight and liquidity is really being pulled back in a big way, yes, that's negative for equities. But if you look at the average cycle in most economies, I mean, take the US, Europe, in India, ultimately, yes, the strongest part of the equity returns tend to be right in the beginning of the cycle when, the economy is bottoming out, as arguably at the stage we are in Europe, for example, which is the most preferred market. But equities still end up doing okay if, earnings and other factors continue to do okay throughout the course of the mid-cycle. To us, that's not a reason not to own equities. If anything, that's a good reason not to own debt, because rising interest rates provide you almost certain negative returns in fixed income, while in equities, as long as your earnings continue to do okay, your returns should still end up being better than what you can get in other asset classes.
Manpreet, really good chatting with you, and here's wishing you a very happy Diwali from all of us here at AD Now.